Hello, and thanks for joining us for the latest segment of Equicapita's Little Book of What Next webinar video series. Michael Cook and Stephen Johnston joining you today. Today we're going to talk to you about forecasts and how those are how those influence a business valuation in the context of a transaction, which is Chapter 7 in our book. Typically, what we're looking at when we see business is we're trying to figure out what the maintainable future cash flow of that business is. And as we've mentioned in previous segments, our best predictor of the future is what the business has done in the past. And we often see business owners or advisors project very dramatic growth profiles for those forecasts in the future. And we view that with some level of skepticism, especially when a business has been relatively stable and consistent in the past. A forecast that shows dramatic hockey stick growth in the future makes us wonder, what's the point of putting that in there? And Steve, maybe even mention to our audience how we view it and why we view that forecast, with a great deal of skepticism, if you will, when it's dramatically growing.
Yeah, I think Mike makes an interesting point. I guess there's two types of buyers in the market, and there's the buyer that Equicapita is, which is a buyer that's is interested in stable historical cash flows that just continue in the future. But then there's the vast majority of private equity buyers who indirectly, they're looking for growth. And so that pressure flows through to advisors and vendors to say, I have a business that's been behaving in one way for 15 years or 20 years or 30 years, and now that I'm going into the PE market to try and transact, I'm suddenly under a lot of pressure to show this an amazing change in the growth profile. And we really think it's counterproductive. A business that's been stable, that isn't a negative, that's a positive. Mm-hmm. And to try and change a business or force a business like that to look like a growth business really isn't credible. It damages the credibility of the advisor, it damages the credibility of the vendor. And also, I think it indicates that you're positioning your business for sale to the wrong type of people. If showing growth is necessary to transact a sale, you're selling into a part of the PE market where your business doesn't fit. It fits with a buyer like us. And so that's really important, is to be realistic and objective about the future. And as Mike says, when there's suddenly this big change in the expected outcomes of the business, as a buyer, we've got to view that with some skepticism. And certainly vendors typically want to be compensated for that change in growth. And then it becomes neither fish nor fowl, is the expression. If you have a stable business that suddenly is showing a lot of growth, a growth buyer may not take that as a reliable outcome, and certainly as a buyer that's interested in stable historical cash flows, we don't particularly want to pay for growth, and so it puts you in a very difficult position. If you have a stable business, that's a positive, and don't be talked into generating growth out of thin air. Present it as is, I think, would be our recommendation.
Yeah, no, I think that's very true. So I think that the message that you're trying to send, Steve, is be very objective and rational about that forecast with respect to, putting it out there for potential buyers, because we really view it as the past is the best predictor of the future. And if your forecast shows some growth, that's a good thing. If it shows dramatic growth, we would question, possibly how come it hasn't been done before. So again, just high-level perspective on forecasts and how they impact value. And thanks for sharing your time with us today for Equicapita's Little Book of What Next webinar video series.